Faces. All right, let's get started. I'm going to share my screen and then talk, because that's what you do. Okay, well, now what happened? Okay, can you all see the screen that says weights and measures? If you can give me a nod. I lost the chat when I did that, so I don't know how to get it back. Great. I got a nod from Sean. Thank you, Sean. Okay, so this is something that I know a lot of agents run into. I'm actually dealing with a couple clients right now. When you have clients that are shopping at their limit, like we've stretched their debt to income ratio as far as we possibly can, the minute details between a property can make or break it when you were looking at the house and not realizing that it was going to make that change, because the sales price could be the same or the sales price is different, but the adjustment to the property taxes, it all can make or break very, very quickly and very easily. So I wanted to put this together to talk through how to really look at the numbers and analyze it. So if you need to on the fly, you can kind of figure out if something's going to work for your clients or not. At the end of the day, it does not replace a good mortgage partner who can really help walk you through all of these details. But to be able to do a quick calculation on the fly is going to impress your clients and saves you the hassle of trying to track someone down if you can't get a hold of them quickly. All right. Okay, so what we're going to go through today is what makes up the pre-approval. This is just a basic recap. Most of you are going to know this. We're going to go through why some things weigh and affect the approval on a higher scale than others. And then I'm going to take you through some dry case study with numbers. It's not fun, but it gets the point across. And then talk through a little bit of how you can use a seller's concession to your benefit to try and get a deal done or keep a deal together when you're kind of at this limit. And then, all right, so the pre-approval is made up of four main categories. It's the client's personal information, so we're getting their name, social security number, date of birth, their 2-year address history, including housing costs. So we're collecting where they're currently renting or if they're living with family. We get their marital status, and that's to know if there's going to be other parties involved in the transaction. We get their education history, which is asked because that ties into are there student loans, and then number of dependents, because we need to find out sometimes if there's alimony or child support payments coming in or being paid. So all that personal information is collected as part of the pre-approval process. We then go through and get a full 2-year employment history, including job titles, start dates, end dates, and their income information. The most recent job income is obviously the most important, but we do look at the prior history as well, as because depending upon what their job style is and how they get paid, that history will factor into or can factor into what they're currently or what we're allowed to use for their current income. We're going to go through their assets, all of their bank accounts, retirement accounts, stock portfolios, anything that they're going to pull money from for the purchase of the house. So if they're not planning on using the funds and they don't need it, generally we leave it out of the equation. But if it's something that they're going to use, we're going to ask about it and go through the details for it. And then lastly, we pull the credit report, which gives us the credit score to make sure that they're eligible, gives us the list of all their liabilities, commonly known as debt, and then gives us details for any other properties that they might currently own. And that's going to factor into the debt. All of those pieces factor into the pre-approval to make sure that a client can qualify to buy a house. All right, so why do some things weigh more on the approval? So all the things that you see listed on this page, income, liability, sales price and loan amount, property taxes, homeowners insurance, condo HOA fee, and mortgage insurance, all of that is what creates the debt to income ratio. So it's a matter of looking at all of the income, all of the debt, and then everything revolving around the house factors into that monthly payment, and that affects the debt to income ratio. And the debt to income ratio is what determines what a client can qualify for. The credit profile determines if someone can qualify. The debt to income ratio determines what they can qualify for. So someone might be able to qualify, but they only qualify for a $100,000 house, so then they're not going to go shop because that's not the price point that they want to be in. So they are looked at separately. In regard to income, income is analyzed based upon a monthly figure. So if they're paid salary, it's just taking the annual salary, dividing it over the 12 months. If they're paid hourly with fixed hours, it is generally looked at with salaried income as a salaried income. So if we can show that they're consistently working 40 hours every single week, generally the underwriter is just going to take that and look at it like it's an annual salary. It keeps the calculation easy. If their hours fluctuate, they're going to do an assessment over the last 2-year average of what their income has been, along with what their year-to-date average, and usually they're using the lesser of. So right now, that's happening with a lot of people right now because of COVID-19. They're going to take a look at what was their average hours and average income for the past 2 years for this job, and then what is it right now, and they're going to kind of tie both of those pieces together. So they'll use the lesser of, but sometimes it is still the average. They'll just factor it into the bigger average as opposed to just using what they're making right now. So someone that returned to work May 1st, for example, if they're back at their normal 40 hours and they're working, we're not going to necessarily use that full 40-hour income because they had a 2-month gap. Let's pretend they had a 2-month gap where they weren't making income. The underwriter needs to factor that in because that's going to factor into their total income that they will have made for 2020. So if the hours fluctuate, it's a little tougher. Again, if it's fixed or salaried, then most likely I'm going to be using the full income piece. For bonus and commission income, it's based upon the last 2-year average. If they have not received it for the last 2 years, we're generally not allowed to use it. They've got to show that you've got the history of having it to know that we're going to continue to have it. Similarly for self-employed, if it's a conventional loan, I have to have at least 1 full year shown on the tax returns. So if someone starts midway through the year, that first partial year does not count. It has to be a full 12 months of the self-employed income. FHA requires a full 2 years. So it's a longer time for people that are considered self-employed or paid 1099 as a contractor. On the liability side, we also look at everything again as a monthly cost. So with credit cards, it doesn't matter what your balance is, doesn't matter what you actually pay, it matters what the minimum payment is. So for most credit cards, that's going to be pretty low. So you could have a $3,000 credit card balance, the monthly payment might only be $35. You might pay $150, we're only going to use the $35. So there's a little bit of break with the credit card debt, which is nice. Installment loans, they're straightforward. Car loan, you're paying the same thing every month. We're using that flat amount. Student loans. If there is a payment reported on the credit report, I can use that number that is being reported for a conventional loan. So if they're on an income-based repayment plan, it'll allow me to use that reduced payment calculation. If the loans are deferred, it defaults to the FHA rule, and the FHA rule is 1% of the principal balance. So if someone has $100,000 in student loan debt, I have to use $1,000 a month against their income. That's what's killing a lot of people right now who have high student loan debt, is we've got to use a lot to be able to qualify them, unfortunately. It doesn't matter if they're in an income-based repayment plan, I'm using 1% no matter what for FHA. So if they've got strong enough credit scores or okay enough credit scores, we're generally going to push them towards the conventional side because it's going to give them so much more flexibility in their debt to income ratio. And then lastly, mortgages, we're using the full principal, interest, taxes, and insurance payment, plus any HOA or condo fee. If it's a rental property, we can factor in rental income, so long as there is either a signed lease that was received within the past year if they just started renting the house, or if they've owned the house as a rental property for more than a year, whatever the most recent tax return income shows. We do have to follow the tax returns for that rental property. One thing to note about the self-employed income, people think that they're self-employed and they make a lot of money because they'll show a lot of gross income for self-employment. We actually don't use the gross income, we use the net income. So we actually start at their worst number and then add in some of their write-offs, not all of them, but some of them, to gross up the figure a little bit, but we can't use the gross. So if someone's showing they make 200,000, but their accountant's writing off 150,000, my base starting salary for them is 50,000, not 200. So it's tricky when you've got self-employed people that really like to write off a lot of expenses so they're not cutting a check to the IRS. So it's just something to keep in mind. Self-employed borrowers very rarely qualify for as much as they think they're going to qualify for, unfortunately, because of that. Sales price and loan amount. This does not affect the monthly payment as much as people think it will. And the reason for that is for every $1,000 increase or reduction in purchase price, it only adjusts the monthly payment about $5. And again, we're looking at everything on a monthly calculation. So what's the monthly payment? Same thing with the loan amount. If you adjust the down payment, so the loan amount is going up or down, every $1,000 is roughly $5 to the payment. And the reason for that is the mortgage loan is amortized over 30 years. So when you take an amount and you spread it out over that long, the amount that it's affecting the monthly amount is very minimal because of how it's spread out. If it is a shorter loan, like 15 years, then those changes do increase the payment a little bit to about $7 a month. On the flip side of that, why property taxes make or break and kill a deal so often is because the property taxes are only spread out over 12 months. So that same $1,000 increase in a sales price is only $5, but that same $1,000 increase on property taxes is $83 a month. So it's just because it's not being spread out as much, it makes a bigger swing on the monthly payment, and that affects your debt to income ratio. When you're looking at a house, or when you're looking at houses, if your client's shopping at their limit and you find one that has a tax abatement, we can use the tax abatement when they're qualifying. So they're going to be able to stretch a little higher if the house has an approved tax abatement. Homestead exemptions, however, cannot be used. And the reason for that is they're optional and not everyone remembers to apply for them. So because it doesn't exist when they buy the house, we can't use the homestead exemption. But yeah, the shorter amortization, why it's only spread out over 12 months is why the property taxes make or break so many deals for clients. Homeowners insurance, similar to taxes, is only spread out over 1 year. It's an annual policy, so the adjustments have more of an effect. Luckily with homeowners insurance, the adjustments there are generally smaller. But for an example, every $50 increase or reduction in the annual policy amount adjusts the monthly payment $4. So that's making almost as much of a difference on the monthly payment as $1,000 added to the sales price. Condo and HOA fees, and again, something that's tougher because the monthly amount is usually higher. Every $100 increase or reduction in a condo fee is going to adjust $8 in the payment. Using an example of a $400 per month condo HOA fee, this is something that's really good to know because it's a ballpark that holds pretty true for most clients. So if you've got a condo fee, so if you've got a client that's open and willing to looking at both single family homes and condos, assume whatever their max price point is for a single family home, it needs to be about $50,000 less for the condo. That's going to be based upon a $400 condo fee. Most condo fees kind of land around that $400 per month amount. There are some that are less than that. And there are definitely some more high-end units that are much higher than that. But $400 is going to get you most condo associations decently covered. And just remember, if someone's shopping, you've got to make that $50,000 adjustment. So don't show them $300,000 condos and also show them $300,000 single family homes. They're not going to qualify the same. Mortgage insurance. Mortgage insurance is another one that gives us, there's a lot of ways that we can adjust it and play with it and move it around to help a client qualify, especially if they've got extra cash that they can play into the mix. On the FHA side, mortgage insurance is calculated the same for everyone, so it does not change per client based upon their credit score, which is nice. So for FHA, the only way it changes is at 5% down payment. So you see for 3.5% down, it's 0.85% of the loan amount. For 5% down, it drops to 0.8. That's the only adjustment that FHA ever makes for mortgage insurance. Any other changes to down payment aren't going to change it again. And FHA, you have mortgage insurance for the life of the loan. Conventional, it's calculated the same way. It's a percent of the loan amount that is then divided by 12 to get the monthly amount. However, conventional is all done on a sliding scale. So the larger the down payment and the higher your credit score, the less mortgage insurance you need. The lower your credit score or the smaller the down payment, the more mortgage insurance is going to be required. It's all done in blocks. It's a grid pattern that all mortgage companies have access to. And I've just given you the two examples there of the best and the worst. For conventional loans, if you've got someone that needs to stretch the debt to income ratio a little farther and they've got extra cash, paying the mortgage insurance upfront is a great way to allow them to do that. Upfront mortgage insurance is generally offered at a reduced price, so they're getting a discount on what they're paying as well. The client needs to know that they're going to stay in the house long term though. Because you're paying it in bulk up front, you've now paid for the full length of the policy, regardless of how long you own the house. So if they end up selling the house in 3 years, they didn't get their money's worth, they overpaid. In general, on a 5% down loan, the mortgage insurance on a conventional loan is going to go away somewhere between year 7 and 8. So they want to know that if they're going to pay this up front, that they're going to be staying in this house at least 7 years. Otherwise, it's not going to be worth it. So it's about having that deeper conversation with our clients to know what their long-term plans and goals are. To give you an idea of the savings, the third bullet point on the right breaks that down for you. If they paid it up front, it's going to be roughly $3,500. If they paid it monthly, it's going to be roughly $97. So if you did that $97 per month over 7.5 years, they will have paid $8,700 in mortgage insurance. So it saves them a good chunk. And this is across the board. So that's for a client that's at the top tier. Again, it's more expensive if you're at the lower tiers, but the break is the same. So it's going to still save them a good chunk in several $1,000s. So it's a viable option for clients who have that little extra flexibility. All right, so let's go through a quick conventional case study. So it's a 30-year fixed conventional loan, $300,000 purchase price, $3,000 in annual taxes. Interest rate they got was 3.5%, down payment was 5%. So if you've got a client, they find a house that they love, but so their pre-approval is based upon this page right here that you're seeing. They find this dream home that they love, and all of a sudden you're like, well, crap, they're not going to qualify. The taxes are not $3,000, they're $4,000. So it's adding in an extra $83 a month because of that $1,000 increase. So they've got a couple different options they can try and do to make up the difference. So option one, if they've got the extra $3,600 sitting in a bank account that they can pull from, they can pay the mortgage insurance up front. It eliminates the $98 per month premium on the insurance policy. Boom, they qualify for this house. That's the easiest, most cost-effective way to get a client's debt-to-income ratio back in line on a conventional loan. Number one option we're going to go to when we run into this situation. Second option, they could increase their down payment, which then lowers the loan amount that's being borrowed. However, they're going to have to put down an extra $15,000. So that's why it's not as cost effective as the mortgage insurance. Lastly, you can always try and adjust the sales price, put in a lower offer, hope that the sellers are going to accept it, and go from there. These are your three big options. There's ways to kind of nickel and dime it, and we'll go through that with the FHA scenario. All right, so the math for how we got to that. So the $4,000 in annual taxes, it's an $83 a month increase over what they were previously pre-approved for. We know that for every $1,000 increase in price, it changes the monthly payment $5. So if you divide what it's saving you by reducing the loan amount, it's divided by 16. So you take the 16 times the $1,000 that they've got to reduce the sales price. That gives you what they need to put in for the offer. Again, that's tough. It's a large ask for the sellers, but it's an option. On the FHA side, so same setup, same scenario, just switching it to an FHA loan. And I wanted to give you both because you don't have the option to pay the mortgage insurance up front on an FHA loan. It's not an option that exists. They're stuck with it monthly for the life of the loan. It's how FHA runs their shop. So same situation, same scenario. Dream home, $4,000 in taxes. They're now off by $83 a month and can't technically qualify. So this first option is how you can kind of nickel and dime it to death to get it to work. So if they don't have a lot of money left over, but they've got a little bit that they could put towards, they could increase their down payment from 3.5% to 5%. It's only an additional $4,500. This is going to reduce the loan amount and reduce the mortgage insurance. That combination saves them $36 a month. So that's getting us a chunk of the way there. Then let's say they have a homeowner's insurance policy that equated to $125 a month. I'm going to have them call their homeowner's insurance agent back and say, hey, I need to strip my policy down to the bare bones. Let's get it down to $90 a month. That saves you another $35. And the nice trick with homeowner's insurance, we only care about what the policy says when it's submitted for underwriting. They can close on the loan 2 days later, call their insurance agent back and completely change their policy and how much it's for to give themselves all of the coverage back that they want. Doesn't matter. Once you've been approved for the loan and the loan has been closed, what you do after the mortgage industry doesn't care about. So if your clients are ever like stressing, like, oh, I don't want to strip that, the policy, the coverage is so tight and so low, if something happens, I'm not protected. All they got to wait until after they close the loan, change the policy back to whatever you want, and you're good to go. It's just to get it through underwriting. It's a little trick of the trade. But doing something simple like that saves them $35 a month so that we can get the approval done. So it's a great little trick. And then the last thing, so we're now off only $13. So now you could reduce that sales price, $3,000. That saves you that additional final $13 that you needed. So in an offer of $297 compared to $300,000 is much more likely to get accepted than the next scenario, which is just reducing the sales price. So that's how you can kind of nickel and dime it to death to make it work. You've just got to look at the full picture and see what you can do and how you can do it to make this work. Second and third options are the same with the last scenario. If they've got a lot of extra money, they could just increase the down payment, or they can reduce the offer on the sales price for the house if the seller will accept it. Math for that one, again, is the same, how we got to what we needed for the reduced sales price. All right. Seller's concession. If you've got a client that's not using the seller's concession, but is shopping at their debt to income limit. So they've got plenty of cash, but they're at their limit for the debt to income ratio. So they weren't planning on using the seller's concession because they wanted to instead of using the seller's concession, they wanted to go the standard route where you're trying to negotiate on sales price. If they're not initially using it, this gives them some extra leverage. So FHA, you're allowed 6% on the sales price. Conventional, how much you're allowed for a seller's concession is based upon the size of the down payment. So it starts at 3%. That's what's most commonly used for conventional loans. It does go up to 6% when they're doing 10% down. And then at 20%, they can use 9% down. No one's ever going to need 9%. Even in Philadelphia, the closing costs aren't that high. But like I was saying, when your clients are tight on debt to income, you can use the seller's concession to cover closing costs, which then frees up additional cash for the buyer to put towards the down payment or to pay the mortgage insurance up front. So it's about using all of the tools in our arsenal to sit there and move the numbers around and shake it out so that it works in a way that works for your clients to make the house work. It doesn't always play out. It's sometimes you just can't make the numbers work, and if you can't, you can't. But there's just different ways. And we're also talking about this as if they're shopping at their limit. Let's say they're not shopping at their limit, but they just have a really firm budget. They're like, I can't go over X dollars per month. You can use these exact same tools to take a house that's a little bit too high for the monthly payment to try and make the monthly payment work. So it's just a matter of, talking with your clients, making sure they're open to this, making sure they're listening to the advice of their mortgage loan officer, because these are all tools that we know to use, and it's just going to be based upon the client's individual scenario. One other thing to note with the seller's concession, if you negotiate a large seller's concession and it ends up that we don't need all of the funds available, we want to do our best to make sure that we're using all of the pennies within that seller's concession. You don't want money left over to the table, because if we don't use the seller's concession, it goes back to the sellers get a bonus, your clients aren't using as much. So the easiest and best way to use any extra funds from the seller's concession, if and when we realize we're going to have money left over, is to pay points and buy down the interest rate. This is also going to reduce their monthly payment. So again, little ways that the seller's concession can help you. Like if they don't want to do the large seller's concession, they could always do a little bit. We can buy down the interest rate on the loan, which lowers the monthly payment, again, saving them a couple bucks a month. So it could make or break a deal. So there's just little tools to make the numbers line up for you. All right. As the realtor, I don't expect you to remember all of this or know all of this. It's just knowing little pieces. So $1,000 change in taxes at $83 a month. So we've got to come up with $83 a month. $1,000 in change in sales price is $5 a month for the client. So that's another good one when the client's like, oh, that house is too expensive for me. If it's only $5,000 over what previous houses that they liked, you can go, all right, well, that's only $25 a month more. Is this house worth $25 more a month to you? It's just having those little nuggets that you can quick fire off will really show your clients that you've got their best interest in mind and you're really thinking about this for them. At the end of the day, the greatest tool you can have in your arsenal is a good mortgage originator. If your clients aren't coming out of the mortgage pre-approval phone call with a really good understanding of their situation and what they need to do, or if when the pre-approval sent to you from the mortgage originator, if they're not giving you some kind of loan estimate or breakdown that shows you, here's the sales price that I use, here's the taxes that I use, here's the mortgage insurance that I use. Because if you have that baseline that we're using, you can sit there and tweak and adjust as you look at houses based upon these calculations. So if you're getting pre-approvals and you have no idea what numbers the mortgage person was using, or if your client's asking you 900 questions that the mortgage person should have told them, you're not using the right person. Just like you have a responsibility to your clients, I have a responsibility to my clients. I'm helping them make a large financial decision. It is not in my best interest to keep them in the dark. So you want a loan officer who's going to work for you and work for your clients so that they are informed and they know what they're doing and can get it all done. So if your loan officer is not doing that, find a better loan officer. When clients are coming to you with pre-approvals from other companies that you've never heard of, or is some online company that's based out in California or something like that, if they're not getting the level of detail that you want, explain to your clients why you want them to use a local lender, why you want them to use someone like Garden State Home Loans or one of the other MSAs at Keller Williams Philadelphia. It's these details that matter. It's the details that make or break a deal. So the loan officer is not doing their job if they're not explaining this to your clients. The loan officer's not doing their job if it's not reviewing their credit with their clients. I have so many clients that got a pre-approval from somewhere else and they're rate shopping and they talk to me. I'm like, well, what's your credit score? I have no idea. Because the loan officer literally just pulls the credit and says, great, you're approved. And that's it. It doesn't doesn't review the debt with them to make sure that the debt is accurate and correct. Because if the debt's wrong, I can start excluding debt. They should know their credit scores when they come out of the phone call. I have the full credit report in front of me. If your clients don't know this information, the loan officer is just plugging through and getting it done, another deal. They don't care about the clients. You want someone who's going to care about your clients. All right, I'm going to stop my screen share so I can see the chat again and see if there's any questions. All right. Let's see. All right, Sean, great question. What happens if the tax abatement only has 1 or 2 years left? So the mortgage industry as a whole, and this is for income, this is for everything. We use a history to determine the future. That future is 3 years long. So when we're approving a client, we're assuming that whatever we're approving now is going to be the same for the next 3 years. So if a tax abatement is scheduled to run out within the next 3 years, we will not use the tax abatement. We will use the full tax figure that is assessed on the property. And that is because we need to know and show that the client can qualify for at least the next 3 years for this house. That's a really good question. So especially the tax abatement program starting to get close to that 10-year, I think it's close to it when they first started. I don't remember when it initially started, but you're going to have houses where that's going to start to be the case on a more frequent basis. You've just got to keep that in mind. Find out when the tax abatement was started and when it runs out.
But Adam, if I made a follow up on that.
Yeah.
So like, for instance, let's say some areas like Graduate Hospital, where after the abatement runs out, I mean, the taxes are very, very high.
Yeah.
Like maybe, I don't know, 8, 9, it's just a very, very high amount. So that's going to considerably lower, I guess, the cost of the home that they could purchase. Is that correct?
Yeah, 100%. Yeah, they could be looking at a house in Point Breeze that has a tax abatement and looking at a house in Graduate Hospital. Let's pretend the houses are the same price. That's never going to happen in Point Breeze and Graduate Hospital. Let's pretend they won't qualify for the house in Graduate Hospital. You're 100% correct. Because we've got to look at that. This is, again, if they're shopping at their limit.
Right.
Regardless, even if they're not shopping with their limit, something to go over with them, because they need to know in 3 years, because most people own, I think the nationwide average right now is the average person is keeping a property about 7 years. Mm-hmm. Correct me if I'm wrong, but I think that's where it's at now as an industry. So if it's going to run out in 3 years, your clients need to know that, because most likely they're going to be there longer than that. So even if they can qualify, it's something that the loan officer and you as the realtor want to make sure that they understand, like, yeah, this has a tax abatement, but this will run out on year X and your payment will substantially increase. And the nice thing with the city's website is it gives us that full assessment value. So I can calculate out and I can tell them specifically, here's what your payment is going to jump to. Are you comfortable with that? I will say the Philly website for property taxes is fantastic. I wish the suburban counties in New Jersey had the same thing. It's so nice and easy to use to figure out taxes on a property.
For once, it did something right.
Yeah, exactly.
Thanks, Adam.
Yep. All right. When it comes to a condo building with a 10-year abatement, is the land okay? Yes. So with a condo, so if it's a new construction, and it's not just for a condo, this actually isn't just for a condo. So if you have a development that's being put together and it's a condo, or it was one parcel, like it was an old school building that they tore down and they built 20 single family homes, they are taking one parcel of land that has one tax figure and they are subdividing it out based upon the number of units that are now going into that land. Because by the time we close on the house, generally the construction's not 100% done if they're single family homes on some of the other houses, or if it's a condo, the city hasn't done their reassessment to split it up. So what's generally going to happen is we're going to take a look at that full, and the city actually provides a calculation to the title companies for this. So when the title companies send the mortgage lender their tax certification, it's going to have done this calculation for us. But yes, you're correct. What they will generally do is they will take, here's the assessed value and taxes for this full parcel of land, and they will divide it by the number of units that are now being put on that parcel. And that is then assigned to each individual client as their share. If there's not a tax abatement, it's done at the full. If there is a tax abatement, which there usually is in that scenario, it's done it just based upon the land. But if it's $10,000 in taxes and there's 6 units, they're going to, each unit is going to be responsible for more or less $1,700 in land taxes that they have to pay. That is how it's calculated out. Other questions from the people in the room? And again, I will send this presentation out so you've got it, so you can kind of commit those little quick calculations to memory. If you're ever unsure, it's best to talk about it in kind of a soft, non-committal way when you're talking with your clients, because you're not going to have the numbers 100% in front of you. So keep it general. Like, I know that this is going to be roughly $5 more a month or $6 more. Keep it soft. Say roughly. Don't quote yourself as here's what it's going to be. Like, this is going to be estimated at, or this is going to be roughly. Give yourself that little bit of a buffer so your client's not, and let them know, like, I'm not, this is not my area of expertise, but based upon what I know and my experience, here's what I know it will roughly equate to. Reach out to Adam, reach out to your lender to get specific firm details. You just don't want to put yourself in a situation where they're mad at you because the numbers didn't line up to exactly what you told them. So keep it soft, keep it ballparked, and make sure you're using that kind of language to keep your clients happy and yourself protected. All right, with that, any other final questions before we go?
Actually, I do, Adam. You hosted a call a couple weeks ago, and thank you for that. I took notes on that. And I actually learned a lot as far as the processes during COVID and I guess post-COVID, like some of the things that you mentioned. There's employment verification, like up to the same day of closing. What else? Furlough employees, they must show that they're back to work, etc. Is all that still, even though it's been a couple of weeks, does all that still apply today?
So no one has released the employment verification rules yet. So the same day as settlement, furloughed employees being back to work, that's all still accurate. The reserve requirements that I talked about, that has gone away. So they relaxed a little bit with that. I haven't heard of anyone re-relaxing FHA credit score requirements. So most lenders are at 640 or 680. Again, I can do less than that. It's just a slower process because our one investor that does them is like the only investor that does them. So they're just inundated with business. But to my knowledge, the only rule that started to re-relax was the reserve requirements.
And Adam, this was the one,
the additional assets that they were.
The 3-month reserves, or I think I have something here as far as 6-month reserves for
Correct.
each if you are a property owner and use the income from the property, it's 6 months or.
So there will always be reserve requirements if you own a property. It's just not that set 6 months. There's a conventional mortgage. There's a conventional calculation that Fannie Mae released a couple years ago. It's defaulted back to that, and it's based upon not If you own the home, it's based upon how much of a loan you have on the house.
Got it.
So yeah, so it's the reserves have defaulted back.
Thank you.
Yeah, Devin, rates are looking good. I've locked in my past couple 30-year fixed clients at 2.99. So that's pretty fantastic. 15 years, about 2.75. Again, it's not set for everyone. Those are conventional clients. FHA's still chilling, low threes, 3%. Cash out refinances are higher, renovation loans are going to be higher. Those are both considered higher risk programs, so they'll always be higher. But for your standard conventional, they're really strong right now. So definitely a smart time to buy. It's like borrowing, it's like buying a house for free. 2.99% is insane for a mortgage rate. So yeah, so if you've got past clients and you haven't done an email blast or a touch to talk about refinancing, use that as an excuse to call, because if anybody's sitting over 3.75% on a conventional loan, I can probably get them down to the 2.99. So use it as a marketing tool for yourself to get back in touch with your database, talk about how good rates are. First time incentives, there's nothing special or unique right now. Generally in times that are hard, those kind of incentives go away. So it's kind of like how the FHA credit score requirements jumped up to 640 or 680. When things are unique, when things are tough, when the economy's slipping, the higher risk stuff will always go away first. The standard stuff will stick around, but the high risk stuff always goes away. So first time buyer incentives, there's nothing new. There is, I can come up with one, Anastasia. I'll put something together, I can send it out. But there is, so there's still the Philly First Home Grant. That's still working and flowing. The city reassessed how to do it, so they're able to do it remotely now. So it's all being done via Zoom. So that's closing and operating correctly. The state programs, PHFA, New Jersey HMFA, those will always exist for down payment assistance programs. Nothing new has been rolled out to my knowledge, and I don't think anything's gone away. So that's all kind of just the same. But yeah, I can put together a script or a conversation starter that I can send out. I'll send it out in the same email. I'll send out the PowerPoint presentation from today that you can use as a script for when you're calling your clients to talk about refinancing. And when your clients, and I'll put this in the script, but when your clients aren't going to know what their interest rates are. It's one of those things, everyone cares about it when they're mortgage shopping, and then the second they close on their house, they've completely forgotten. They make it into this big deal that they end up instantly forgetting. So when you call your clients and you're going to ask them, to see if they should refinance, they just need to have a mortgage statement. All they got to do is grab their mortgage statement. It's listed on the statement, what their current interest rate is. That's all they have to do to say, oh yeah, maybe I should look into this, or no, I'm good. I'm down at 3.5. I'm fine. The mortgage statement's the key. It's what we need to give them a refinance quote. So if they can grab it or pull up the app on their phone, if they use a company that's got an app, that'll be the key piece. So I will send out that. I can put together a script for that. Discussing forbearance. The key with the forbearance is they need to know dates. If they don't know dates, it's really tough. We can pre-approve them. They can start shopping for a house, but if they don't know when they're going to return to work, you don't know when you can close. Because I've got to get 1, maybe 2 pay stubs before we can get the approval through underwriting. So that's depending upon their pay stub. If they're paid biweekly, I might need up to 2 pay stubs. So that's a month just waiting for that on its own. So the hard part about the forbearance conversation is when the clients don't know dates. So that would be that's where I would start the conversation. Like, you're in forbearance? Or no, I'm sorry, you said forbearance. I was thinking furloughed for work. My apologies, wrong word, wrong FUR. Furloughed, we need to know when they're returning to work. Forbearance is tough. Our largest investor, it's still something that the industry is scrambling to deal with and come up with a unified rule for. Our largest investor at Garden State Home Loans, I know Fannie Mae is working on national level guidance, but before there was any, our biggest investor said if you put your loan in forbearance, you can't do anything for a mortgage for 12 months. So it's a huge setback for anyone that took that forbearance. So it's not seen as it's kind of seen as a blemish. So there's other investors out there that I know that are looking at it as, and I think it's the direction that Fannie Mae is heading for the government for their guidance, is that what will be required for the forbearance is to show that they are now out of the forbearance. Any past due amounts that was waived during the forbearance has been repaid. Because remember, a forbearance doesn't skip the payments, it just pauses them. They still have to pay it back as soon as the forbearance is forgiven. So if a client is talking to you about doing a forbearance and they haven't done it yet, tell them to run away. Don't do it. Unless they absolutely cannot afford their mortgage and don't want to go into foreclosure, and that's the only option, don't do it. Because regardless, they're going to have to pay that money back, and it's not easy for anyone to do. So all of a sudden have to have that 2 months, 3 months to just write the check. If you didn't have the money in the first place, you're not going to have it when it comes due. So if they haven't seen it, or if they haven't started it, don't have them start it. But at the very least, they're going to have had the forbearance closed out and show that they are caught back up on the needed funds for the mortgage, so that the mortgage payments are re-caught up. At the bare minimum, that's going to be required. There might be a time frame that's required after. Again, industry is still waiting on guidance, so each lender is kind of handling it a little different based upon what they see as the risk threshold for it. Yeah, so avoid it where you can. It's just the best way to go forward. All right, any other questions? No. All right, awesome. Well, I appreciate all. If you need anything, give me a call, shoot me an email. I'm always here to help. But with that, I will leave you to your Wednesday, and I hope you have a great and productive day. I'll talk to you later. Bye.
Thank you very much, Adam.
Thanks all.